I'm Matt Bichard with NAREIT's REIT.com here in Phoenix, Arizona for REITWise 2015, NAREIT's Law, Accounting, and Finance Conference. I'm joined today by Ken Betts, International Partner with Locke Lorde. Ken, thanks so much for joining us.
Thank you, Matthew.
We spoke in 2012 about the public non-listed REIT space at a time when there was a wave of liquidity events in the space. Since then, how have you seen the PNL market develop?
Well, liquidity events continue to be very important in the private non-listed REIT area, and we're seeing more and more liquidity events occurring. A report by Stanger recently indicated that in 2012 we had, in terms of initially invested capital, about $10 billion worth of liquidity events. In 2014 it went up to nearly $13 billion, with the watershed mark being somewhere around $17 billion in 2013. The approach being taken by non-listed REITs is sort of broken into almost two different types. You've got about 50% of those liquidity events have taken place in M&A space, which would be portfolio divestitures or mergers. The other 50% have been through IPOs. And what you're seeing is a progression in the thought process of sponsors as to how to more effectively get the liquidity events to occur. For example, in the IPO markets, you're seeing changes in the price protection types of strategies, going away from phased-in liquidity events. In other words, events where initial investors are asked to hold back in the actual disposition of their securities upon the public offering, to more of a tender offer concept where there can be immediate sales by investors, existing investors, into a tender offer transaction. What this means is that sponsors recognize the necessity for liquidity events and are being very clever and creative in the way they're implementing liquidity events.
And given those changes and others expected to come, what do you envision the PNLR space will look like, say, 5 years down the road?
You know, I think it's still going to be a very robust form of real estate investment. But it's going to depend on, I think, three factors. First, the continuous success or continuing success of liquidity events, really creating two positive factors. One, you've got new capital back in the hands of investors who obviously will be pleased with the successful turnover of their investment and will likely reinvest. And then a successful liquidity event will in a sense, validate the non-listed REIT space for non-REIT investors. Those new investors are saying, I see how it works, I want to jump into the space as well, thereby increasing the scope and the number of potential investors. The second factor will be how the non-listed REIT community addresses the increasing regulatory, or the changing and increasing regulatory environment. The SEC and FINRA have enacted new guidelines relating to disclosure about things such as dividends, dilution, non-NAV values, the values of the per-share values and things of that nature, and how the non-listed REIT community reacts to those and adapts will be an important part of the success of the continued success of this investment vehicle. And finally, it's going to be interest rates. If and when interest rates do increase, it'll be interesting to see how investors look at a marginally illiquid investment with a fixed return, and how they're going to look at putting their money into that type of investment in a rising interest rate environment. But I think, all in all, you look historically how, as I mentioned earlier, how creative REIT sponsors are, and how sensitive they are to the marketplace. I think you're going to see this being a continually very robust investment opportunity for people. Okay.
Now, we've seen a number of REITs already focused on infrastructure real estate. Do you think this is an area where we may see more REIT activity in coming years?
I do. In fact, interestingly enough, Larry Fink, CEO of BlackRock, in an op-ed piece he published last fall, indicated that he thinks that infrastructure investments will be the next big opportunity for investors, and obviously a very smart man. Infrastructure investments typically generate long tax losses for a great period of time, even after the time when they are actually fully developed. And so for a REIT, it's going to, since they can't pass on their tax losses to their investors, they're going to have to really decide when in the investment cycle they're going to jump into the REIT space, into the infrastructure REIT space.
Okay. And lastly, what benefits or value do you get personally from attending NAREIT's REITWise?
Well, I enjoy a chance to see peers and talk to people that I've actually talked to people face-to-face that I talk to during the year as we engage in transactions together, getting to see various SEC representatives that are here, and getting to hear from from colleagues and peers what their thoughts are on the kinds of issues we've been discussing, where they think the next issues are going to be faced, and how they actually address them. And it's a terrific opportunity to exchange ideas and to meet with really the best of the best in the industry.
Great. Ken, thank you so much for joining us.
Thank you, Matthew.
For more on this and other REIT news and analysis, be sure to visit REIT.com.